Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, March 1st, 2023, and this is Blockhead Traders Weekly. In this week's episode, I am joined by fellow Blockhead trader Viper XL 007, and we are going to have an update episode to you to the 1% trades. In this week's episode, we are going to look at a total 1% trade summary. Where do we stand today? It's been 3 months about since we started off the 1% trade. So where do our records stand? Where are our profit and losses? And is it going as expected? We'll cover that. Then Viper and I each have a retrospective to do on our most recent trade that closed out last week. Viper wrapped up his wheel on the T, and I wrapped up my BYND. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, a few of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. You can also find all of my trades at thetagang.com/sprocket888, the good, the bad, and the ugly. Lastly, this is available via audio podcast, and you can pick it up wherever you get your podcasts. And if it's not there, let us know and we will get it there. But let's hop to this week's content. Viper up first is 3 months of 1% trades. And here I jotted down where we stand. Now, technically, there is one still running trade out there, and it is my $19 scratcher on Citigroup. We got a couple more weeks left on that. That is a third week in March expiration. So we'll see how that one pans out. But that trade aside, I tallied up all of the wins and loss records and our running P&L. Now, I didn't do a percentage because we didn't really keep track of the risk of each of those trades, and they weren't all evenly weighted. So I didn't go back through and give a P&L percentage, only a dollar amount, cumulative dollar amount. And then I went ahead and put the win-loss record of the trade. So you're ahead of me. I am batting 500 here, 3-3, and I've got a P&L positive of $7. Viper, you're looking at a 3-2 record with a P&L of $27.52. I don't think I showed you this before this moment. So any feedback? Is this where you thought you'd be on a 1% trade? What are your thoughts?
I mean, it's good. Yeah, I hadn't really thought about it or even, collated the effort like this. I mean, as I've been going through, just kind of been spotting it, I've been more focused, I think, on these plays of trying to find things that, fit the theme of, things that are approachable and accessible to people trying to build their account size. So ironically, that means that I haven't really been super focused on the profits. It's more the setup and the risk and the underlying itself. So perhaps there's something to that as far as, having a majority record, we'll say over 50%, and just having that perspective of slower roll and just, not trying to rush through this thing. So I feel like maybe that played a role. And we'll see if now that I acknowledge it, if that ruins it and it no longer plays a role. Actually, next week's episode, we'll spoiler alert. There's a little setup coming that maybe I will throw a real wrench in this. But I'm pretty happy with that overall. And I think if we look, I mean, it was mostly one trade, right?
Yeah, I mean, you had two pretty decent ones there at the end. You got your SDLC long, which has picked up the majority of that, 24.94. But you had your T wheel brought in 9, which is respectable. For me, I'm happy with, I guess, where I'm at. I'm a little less than where I thought I would be at. I knew that my percentage would probably be closer to a 50-50. I thought I might be ahead of 50-50, and maybe I just need a few more data points. but I'm taking this 1% challenge to really kind of showcase different trades. And so I'm not really honed in on a particular type of strategy or a particular algorithm or mechanic. People that might have watched previous episodes, I'm a longtime premium seller, and I do believe that those statistics, not believe, I have data over 1 year of trades, hundreds of trades that, statistically those worked out to the 70% win rate in my favor. But in the 1% challenge, I'm not just doing those type of trades. I'm trying to experiment into other types of mechanics. One, to teach you guys about them and to tell you about the different values in there. Two, because I'm doing that, I'm expecting more variability. So to be positive on P&L for experiments, that basically means, I'm not losing money trying and learning these things where, you'll hear people that take big losses, and probably even myself, if you go back to some of our episodes and say, yep, that was an expensive lesson, where we lost money learning something from the market. So the fact that we can be going through this here and learning while still gaining profit is pretty cool.
I'm pretty sure I said that all last year, the expensive lesson. And hey, it's still cheaper than college. I mean, went to college, but I didn't go to college for this.
Well, we have two trades that we closed out. You can see them. They're there on the bottom, the T wheel by Viper, and then the Beyond trade by my trade. And so, Viper, let's do a retrospection on the T wheel. Where are you at on that one?
Yeah. So as longtime viewers or listeners may recall, I took the options wheel on T, and that was the whole idea of selling a cash secured put with the intent or acceptability of getting assigned those shares, and then you want to roll that around on the wheel like we described before into a covered call. And then you just kind of over time wheel that around as far as get assignment, sell, get assignment, sell. And the difference in that is obviously you're catching premium on each of those options contracts. So real quick before we dive in, I know you kind of talked about it before, but remind us as far as your exposure or usage of the wheel. Have you really dived into it, or you just kind of know about it and have observed it?
No, I've definitely partaken in the wheel, and I'll say I haven't done it a ton, because usually when you're gonna wheel, you want to hold the stocks. Like that's part of your end game, is you're trying to hold the stock, but you're trying to get paid to do it. And I don't tend to hold a lot of stocks in my portfolio because they do consume a good bit of buying power. And so I haven't done a lot of wheels, simply because taking the assignment of that largely will allocate a good chunk of buying power. And yes, I could probably mitigate that by picking underlyings that, when I had 100 shares are within the buying power consumption that I'd want to do. So that's my exposure. I definitely done it. I line them up at slightly different strikes than you did. So usually when I am doing the wheel, I am going to sell the put at the money. So I typically will wait for the underlying that I'm looking at to drop down to almost a bottom range, or somewhere where I think it's going to kind of level out. It might not, but it's where I think is a fair price. And at that moment, that's when I'll sell a put at the money. And the reason I do that is because that's the maximum premium. That's the maximum value that I'm going to collect from that. Now, it's more of a 50-50 shot whether or not you're actually going to get assignment if you do that, because it could bounce right off of that level and you'll never get assignment, but that's fine, because then you still got the premium as your consolation prize. And then what I'll do is I'll probably roll it, and I'll just keep rolling and rolling and rolling until I get assignment. On the flip side, right, once I am assigned, and this is something we didn't get to with your wheel, spoiler alert, you didn't get assigned, is when I am assigned and I'm selling call premium, I'm going to roll it and roll it and roll it and roll it. And I'm never going to take it to expiration. I'm going to force the other side to early exercise on me. That's a nuance that I think we actually did an episode. I don't even remember what one it was, where I was rolling and I was deep in the money and I thought I'm going to get assigned. And I said, well, you know what? Let me go ahead and roll this one more time, collect a little more premium. And then the other person is going to have to think twice about whether or not they actually want to take early assignment now 1 month early versus the couple days early. They did. Spoiler alert. They took assignment and they called my shares away. But I collected a little bit more premium because I did that roll.
Yeah. So with all that in mind, I can confirm quite a number of things that you said in there. So let's jump in over here on my chart and kind of play some of those things out. So first off, this was the setup of the play. We had price coming down from this 20 to this spike. That was a big spike up to 2170, but basically this local high here, 2050. I'm not going to zoom out now, but the previous episode where we talked about this setup, I had zoomed out on the chart and I saw some things. I don't think it was obvious. Like I saw it in real time while we were recording, but I hadn't had time to process and digest it. So I kind of brushed over it and just kept going in the recording. Haven't gone back and looked to see if it was obvious or not when I saw it. But at a basic level here, if we zoom out just a little bit, we can see we're in this uptrend from a dip and recover here, which is a particularly nice setup that I like to look for on just a scalp play. I like to see a level. I like to see a slip loss of it and then a quick regain and hold. That particular setup, it has nothing to do with this play, but it was part of my reading of the chart of like, I like that. That's a good scalp sign. And obviously it played out. Had I been scalping this, there's a nice, it's not a quick scalp. This is the hourly chart, but it still went up eventually. So we're pulling back off of that, and I saw us coming back down. I charted out this $19 level, and I was like, that's the level I think is important. I think is reactionary. And I had this read on this more micro scale of an uptrend on the chart. I was like, I like 19. Let's go ahead and sell that one because in my head, we may not breach that. If we do, I'm fine with it because we are going to go, or not are going to, but my thesis was that it was going to continue to go up, all that good stuff. And then this is where number one, a little emotional, a little quick to pull the trigger. We were coming down, and so some of this is, so 1958 here is where I sold the put. And I did it hastily. And this was the first big lesson of exactly what you just said, of wanting to sell at the strike and not too soon. Because as we saw on the previous chart, I collected $15 for selling this out here. So why the heck did I sell it? Well, I got emotional. I got ahead of myself. I was like, I'm going to do this play. I'm going to do this thing. And I read the chart and was like, oh, look, we pulled back down and we're kind of testing this previous high, which was part of the swing that took us up to this local high. And so this is a habit that I'm trying to break out of, where I don't wait for confirmation. I don't wait for, like, it just touched the level. And I was like, this is it. Go do the thing I want you to do. And I was worried that we would bounce off of here, and thus I would lose more of that premium because we would start to then move away from the put I wanted to sell. So I rushed into the sell and did that. And so that was not a mistake because, I still took $15, but rushed decision number one. Because obviously now, as we can see, had I waited for at least any decent movement at this level up, we clearly dumped down, and we actually went right to the 19. And this is when we got around down here. This is when I was talking to Sprocket about it. And he went and looked at the options chain. And the option that I collected $15 of premium for was then going for $35 of premium. So, that alone speaks volumes to exactly what you said about sell at the money, sell when it's right where you want it to be. If I'm okay with assignment at 19, why the heck wouldn't I wait until price potentially got to 19? If I had a solid read on the chart based on the technical analysis, everything is screaming, wait until you are just a razor's edge away and then sell it. And so that would have played out much better. We got back down here. We did dip below the strike. This yellow box was my break even. The bottom of the yellow box is where I would break even on my $15 that I collected. So that's another thing, is had I waited and collected that $35, that would be 35 cents on the underlying. So that would be $18.65 would actually be my break even, and we'd be way down here. That box would be a whole lot bigger, and that essentially gives me more buffer to play with on moves after I take assignment. So as time goes on here, we obviously bounced there, and I was just all kinds of somewhat regret. And then you can see if we keep going forward here, I also have the expiration in here, which was February 24th. It did what it needed to do if I was playing this like how we talk about playing selling naked puts. And that was another thing I was battling throughout this whole thing, was that mentality of, if your strategy is to sell naked puts, collect premium on selling naked puts, first of all, you're not doing it this close to expiration. At least you probably shouldn't be. But the mentality, because that was the mechanic that I had known previously, the mentality was, oh, good, this is perfect. We're like right up against it, but we're not taking assignment, yada, yada. But like now you can see I'm conflicted. The idea of the wheel is to be okay with assignment and possibly hope for assignment. But in my head, I'm playing this battle of what the wheel wants and what the naked put seller, premium seller wants. And those are slightly conflicting objectives with significant overlap of a Venn diagram. So as time went on here, we were talking in the Discord with some of the other members in the Discord, and he, one of the guys in there, gave a read on T, and he called out the larger time frame that shows a pretty clear downtrend. So now at this point, I'll just zoom out real quick. We can basically see this channel. If I go to the 4 hour, just really bump it out here, we can see this pretty significant downtrend channel that just goes way back. I mean, it like all the way back to 2019, 2018, 2017. And in respect to that channel, we're kind of at the top of it, and therefore potentially rejecting down lower. Now, I would hate to soil this guy's reputation and attach his name to a channel analysis.
Yeah, he's going to be so mad at you. I hope he doesn't listen to this.
So the channel had nothing to do with his read. The channel is what I saw when we were recording, and I was like, uh-oh, this doesn't actually look as good as I thought it did. His much more price action analysis of it showed that, you know, this was a local top and lower lows were expected. So I had that on my mind as we were in this chop zone, where now I was kind of breathing a small sigh of relief, because I was like, I don't think 19 is the thing anymore. I don't think that's the level that I want. And so I was like, well, we're just this tiny little micro uptrend. Let me just gas it out a little bit here. And then you can see on the very last day, we actually kind of got an opening gap down, and it actually came right to the strike. So as it was falling towards this, that's where I was like, you know what, we're on expiration day. This is where I'm committed to. I don't want this anymore. I thought through and learned the everything we just talked about, as far as the better read, the more consistent read I should have had on it. I was like, I don't think I want this, so I bailed out, paid $6 to buy back that contract, took the $9 profit, and all is well. And as you can see, I could have just hung on. We dipped down just slightly underneath, but not enough that I think I would take early assignment on it. came back up and expired out. And then sure enough, as we've moved on, now we're in more of that downtrend down here. So in the end, I still like the wheel. I certainly learned what I needed to learn here, which was not rushing into it, getting a solid read on it. If you have a community or if you have people that, you trust to give you their own perspective without biasing their perspective at all, obviously, as we advertise here, that's what our Discord's all about. Having those conversations, not as financial advice, but just, hey, what do you see on this chart? I mean, the number of times that question comes up in our Discord is, not in a make this decision for me, but hey, I'm seeing this. What do you see? Comes up all the time. And the other thing that you touched on that I definitely felt on this play was obviously when you sell a cash secured put, when you sell any put, your account is going to have the amount of buying power required to fulfill that contract locked up. So even though I never took it to assignment, I did get to feel that buying power getting locked up. And I wasn't a huge fan of it, specifically for what I was playing for, which was $15. And then a potential roll around. And so it was $1,900 of buying power that were locked up. Now, some of that was the poor entry choice. If it was a $35 that I was playing for, that's a little bit better. But that definitely is a factor. And I could see how the wheel, I sold this play as approachable to somebody growing their account. I still stand by that, but that's something that really kind of locks you up, especially on a smaller account, that you really got to be committed to this. You really got to be committed, like you said, to holding AT&T on this. And again, I still believe everything I said in the previous episode as far as this being an okay underlying to hold long term. It has oscillating consistent performance, even though it is in that downtrend, long-term downtrend. But it just wasn't the right timing on the chart for that. And obviously the premium was a little low because of that slow oscillation that it does. It is not a sexy volatility stock by any means.
Yeah, the only thing I'd add to that, which I think probably goes to your feeling of, wow, that's a lot of buying power locked up for not a lot of dollars. I think, I don't remember if it was on air or off air that we kind of talked about it. One of the other prerequisites for my wheel strategy is it's got to be a highly volatile stock. Because to me, yes, if it's a stock you want to own, okay, you might as well get paid to own it, blah, 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 blah. But to me, the real value starts coming in when you have an elevated volatility and you collect that extra premium because it is volatile. We did the comparison, I think, in the episode where you talked about this between this and BYND. It was almost the same size underlying, almost the same size everything, and the same size delta. I think in yours, you collected $15 on BYND. You would have collected like $150. And to me, that is really where the wheel is just awesome, is in that elevated volatility, which makes sense because when you're wheeling, you're selling options, you're profiting on that premium.
Yeah. And I think it's worth pointing out, because I do know that we talked about this on the recorded episode, that really, a lot of that comes down to personal tolerance. Like we said then, that higher volatility, you're expecting it. And so you're expecting to have periods of time where you're wheeling and you're seeing pretty large red numbers because maybe you took assignment and it's volatile, so it actually dropped significantly more, which is totally fine. Like you said, it's volatile, so it's more likely to then, be volatile back up and out. But that's just, I guess, something that we'll probably continue to call out as we talk about wheels as a prerequisite to understand emotionally going into it. Something like this T wheel is going to be much, much slower. Even if I took assignment and, was looking at red numbers right now, they're going to be much slower moving red numbers and on a lesser scale. because it's not glitching, jumping, moving all over the place. But that doesn't make one right or wrong. It's just something you have to be aware of going into it and play to that. Like you just said, the higher volatility, you're expecting that, you're getting the higher premium. It's awesome because you'll get moments of volatility decreasing, and you'll potentially have opportunities and options within that moments of decreased volatility to do something with it. The T wheel, you're not going to really have that. You're kind of stuck in a slow cycle where you can't really maneuver around or do things. You just kind of play it out.
Yep. And speaking of Beyond, which was the comparison we did, let's hop over to my trade that I put on, also nicknamed the Flappy Bird trade. So this was the P&L chart that we kind of talked about. This was strictly a premium selling play for volatility contraction. So I opened this thing up on Monday or Tuesday of a week. They had earnings on Thursday after the bell, going into Friday's expiration. And so this was selling out premium that expired that Friday, same week of expiration. Volatility on this thing was over 350%, which allowed me to basically make a very large opening for that Flappy Bird. And so I've got it right here. You can see we came up right here on this last day where this red candle is. That is the first time the market opened post earnings. So they reported after the bell the day before. They reported everybody was a real positive response to it. It gapped way up in the after hours, and then after the market open, you can't really see here because the wick of this candle is the same color as this rectangular box, but this wick actually went all the way up into the red no-go zone up here for my profit. So for a while, my thing was in the money, meaning, hey, I'm not going to walk away with a winner here. But that candle retraced and ended up closing below where it opened, right there. Expired, absolutely worthless. I sold this thing for $28. I collected each and every penny of that because I took it right into expiration where it was absolutely worthless. And here we are, hey diddle diddle, still hanging out in the middle.
Yeah, that's a beautiful start to a Flappy Bird level right there. Just you got that little pump there at the end. Just you were falling down. Got yourself flying right through it. But also just I feel like it's going to be confusing because of how we talk about contract prices. And you said $28, which that was $28 contract price. So $280 premium price. When I was talking,
No. That was, it was 28 cents.
Oh, okay, 28 cents. Okay, never mind then. Not confusing.
Yes. So it was a 1% trade. So it was a dollar wide iron condor. So I risked $100. I collected 28, hence 28% gain on that.
Right. Okay, that makes sense. Also, because what made me think it was $28 as in 280 was what we were just talking about with how juicy Beyond volatility is and whatnot. But obviously the thing that makes sense about that as a point of clarification is the context of the iron condor, how the iron condor works and how you put these protection legs in and the straddle of it, which then brings that down to risk mitigation, but also premium limitation.
Yeah, and what you're referring to is when I sold that put and that call for my protection, I went $1 out and bought an option. And so, yes, those strikes, if they were the wheel, I wouldn't have bought that protection leg. So I think that put was selling for something like, I don't know, $2.50 or something like that. But then $1 away, I had to buy the other put, which was selling for $2.25 or something, right? And so I then had to turn around and give most of that back for that protection leg, netting me the 28 cents of the trade. That's why that's that way. Hey, real quick, the one thing I also wanted to show up here, because this is just this really highlights that premium contraction. If I switch over here to the chart that I've got up here, this graph down here that's a little red and then it goes green and then it goes red again, this is volatility. Now, this is the monthly volatility, so it doesn't go up to the 300 because I was doing week of. But the point I want to make here is you see this big spike in volume and this little $5 loss. This is the earnings announcement. And right here, we're going from a volatility of around 160%. Earnings comes out, this volatility goes pop, deflate, and then today, we're trading at $100. So we lost right here 30 some odd percent of volatility like that at earnings. And it's that volatility crush that is exactly why I play earnings. That's the setup that I was really looking for, is that immediate volatility crush. And that is what I profited off of.
Yeah. And at risk of distracting the point or complicating it because it's not the setup we're particularly talking about, but a little slight explainer of that is going into those earnings setups, and they are fairly coin flip plays. And so anytime we talk about them in the Discord, it's set up as such, of like, this isn't necessarily a legitimate long-term strategy so much as a fun little coin flip to play. Leading up to that earnings, because that volatility was so green up there, the contract sells way high. And so as you're going into that on the sell side, you go ahead and sell that. And what do? You sell towards the end of the day, like around 3:30, 4 o'clock, or not 4 o'clock, but 2:30, 3 o'clock?
Usually if I'm playing earnings, I'll wait for the last hour, somewhere within the last hour or two, to place that trade. Okay. Didn't hear, but yes.
Yeah. And so then, like you saw on that chart, the whole reason you're doing that, you don't care which way the price, well, you kind of do, but if you're out far enough on your strike from the expected standard deviation that's expected of the move, your whole play is market opens, that balloon is completely gassed, and so as long as you're not breaching your strike, the contract itself is just completely burnt out, and then you just buy it back and move on, and it's a little 12-hour play.
That brings us to the end of this week's episode. Just a recap on those 1% trades. I didn't actually open a new 1% trade this week. I don't believe Viper did either. So we're going to keep our eyes peeled for upcoming 1% trades to put out there. Hopefully you learned a little bit of something on this retrospection. I think this retrospection is really the magic to these trades. It's really that gives you the thought into what we thought of looking back on the trade, what we were thinking about through the trade, talking through the mechanics. This isn't really about, oh, I'm just going to copy these guys and do what these guys do, but listen to us, understand the things that we're going through. Maybe it just sparks an idea in your mind. You go out and research something else. Really, everybody's trading style and trading flavor is a product of the things that they were exposed to. And so our goal is really just to share our experiences with you so that you can develop your own trading flavor, your own trading questions. And that's our whole goal. So, say hello to us in the Discord. Let us know what you're trading. Hopefully you find this helpful. Lots of stuff happening. The market is out there rocking and rolling as always. So hopefully you're finding something. You're latching onto a strategy, doing that paper trading, getting some comfort and some sea legs there. Have fun. And remember, think outside the block.